Hi, everyone. This is Jason Barrack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I had him on a couple of months ago when the oil prices were much higher. I want to have him back on to talk about the recent humongous drop in oil prices and how that affects the United States shale oil industry. He's president of the Energy Prospectus Group out of Houston, which is a members-only group for people who want to improve their investment returns in oil and natural gas. Dan Steffens, thank you for coming back on a podcast.
Yeah, Jason, great to be here.
Now, Dan, let's talk about the big picture of the oil market before maybe we talk about production cuts and some of the potential problems or where the market's overlooking on shale. What's your general consensus here of opinion of supply and demand for the oil market? Is that causing the drop in oil price, or do you think it's something else, maybe involving the Saudis or OPEC?
Well, during the third quarter, the supply exceeded demand. That gap widened, and there was several reasons. One is the Libyans brought back a lot more production. So they were down to about 200,000 barrels a day, and they ran up to 900,000 barrels a day. So that was a big part of it. Because right now, like I looked at the month of October, and supply exceeded demand by about 1.8 billion barrels a day. Now, that sounds like a lot, but you're in a world that consumes like 92 million barrels a day. So, from a percentage-wise, it's not that big. But, all commodities trade on the margin. So when you have this situation where there's a million barrels more a day than supply, then the price goes down and whatever. But it's really also a kind of a seasonal thing. The months of September and October are kind of lower demand months, and then once winter starts, like once we get to December 1st, you have a big pickup in heating oil demand, so that'll shrink it down a little bit. And then the other thing with the drop in the oil prices, a lot of it had to do with the strength of the U.S. dollar. That probably accounts for about $15 a barrel of the drop. So,
yeah, I agree about the strengthening of the U.S. dollar. I mean, these high-frequency trading computer programs out there, when the dollar gets strong, it's pretty much just short oil and short gold, right? That just seems to be what these trading programs have had in there. And I don't personally, in my opinion, think that there's been a humongous amount of demand drop. I mean, I could quote you statistics saying, look at the car sales out of China. I think that's the real demand driver for oil growth in the global picture is for the developing world. So for China, India, Russia, South America, Africa, Middle East, those are the ones who are the new marginal consumers of oil, not the U.S. or Europe, right?
Right. And if you look, I look at the U.S. Crude oil storage report every week, and the U.S. has the largest storage capacity in the entire world. Like, we have about half of the world's storage capacity, not including the Strategic Petroleum Reserve, but it's just commercial storage facilities. And our oil and storage is actually below where it was last year. So if there's a huge glut in oil, where is it? Maybe it's, in tankers floating all over the world, and there is some. But again, I mean, if you're only, producing 1.8 million barrels a day more than what you're using, there's, hundreds of millions of barrels storage capacity. So it's not like, all the tanks at Cushing are overflowing or anything like that. There's still a place to put it. I think this big price drop there was a lot of things that went into that price drop, and part of it was just, the traders, these, speculative traders in the oil market. They went long oil when all the stuff with ICE in Russia started back in July. And then when it didn't really pan out, and especially when the dollar went up, they got killed on those long contracts. So they got a bunch of margin calls in early November, and that causes big, drop in oil prices. Anyway, then OPEC decided not to help out. So you got the situation we got now. I think what your listeners just need to remember, and I've been in oil and gas business for 38 years. I've been through a lot worse cycles than this. You guys might not remember, but from 1986 to 1990, the price of oil was below $20 a barrel for that entire 4 or 5 year period. And, our netbacks were $5 a barrel. So, now you still have netbacks in the plays, in the shale plays of $35 to $40 a barrel. So, you still have a great situation.
Interesting. Now, before we talk about production costs and maybe which shale oil companies are actually doing a lot better than the market thinks, because, we've seen some of these stock prices pretty much just across the board, computer selling down 20, 30, 40% for even quality companies, but some of the ones that are more leveraged with a lot of debt, they've gone down way more than that. I think even a few of them are down 90% since the last 8 months or something like that. But anyways, though, I want to talk about OPEC first. You had an interesting theory about the Saudis and OPEC before we started recording. You think the Saudis, instead of necessarily punishing the U.S. shale oil producers, or the Saudis helping the U.S. government out, or Wall Street out punish the Russians, you think the Saudis are punishing the other OPEC members?
Yeah, I think they were going around meeting with the other OPEC members before the meeting in Vienna on Thanksgiving, and nobody agreed to cut. They said, we'll cut, but you have to match ours. If we cut a barrel, you got to cut a barrel, and nobody would agree to cut. And they pretty much know they're all going to cheat anyway. So I think basically they're sending a message to the other OPEC guys. We're not the only ones in here that are going to, take it on the chin every time this happens. You have to cut back too. So, but you look at these guys like Venezuela, Iran, Iraq. They just feel like they just can't cut. I mean, their budgets are so tight. But I tell you, they're killing the other OPEC members. I mean, if you saw Boone Pickens' interview with Kramer the other night, basically saying, how long can this go on? They're just killing the other OPEC members by doing this.
Yeah, so that's a very good point. And one thing our listeners need to understand is that the Saudis they're basically the lowest cost producer, right, in the entire
yeah. I mean, they could go wrong. Yeah, they could survive in a $70 barrel oil world forever. I mean, they could go 15 years like this and, they're still fine. But these other countries are going to have riots in the street here pretty soon if they have to start cutting their social programs, and they all know it. Now, you hear these conspiracy theories about they're doing this to punish Iran, and they might be. I mean, I'm sure there's no love lost between the Saudis and the Iranians, and maybe they're doing this to encourage them to say, okay, you cut your nuclear program, and we'll drop oil supply. But I think the supply and demand stuff is kind of the fundamentals are going to balance it out anyway. And, this talk about punishing Russia, and yeah, it's hurting Russia. There's no doubt about it. So maybe there's some validity to that. I don't know that I buy into all these conspiracy theories. And I had, one of our members sent me a note that Obama called the king and they worked out this deal. I personally find that hard to believe, but I think the Saudis do what is best for Saudi Arabia, and that's the way it's going to be. Another thing to remember, I mean, this has happened over the years that they've done this, but anytime that they've gone down this path, it hasn't lasted for very long. I mean, 6 months to a year maybe, and that'll be it. And then I think they'll make an adjustment. So.
Yeah, that's a good point there about how long can this last, because in the past, when the Saudis did this, when they increased production rapidly in the 80s, and basically, I believe the trap was set for the Soviet Union back then, because the Soviet Union, when the oil price went from $10 a barrel to $30, Soviet Union took on a lot more debt to increase oil production, and then the Saudis increased oil production. The U.S. brought on more oil production from offshore and also the Alaska, right? And then that drastically decreased the price, and then that almost bankrupted the Soviet Union immediately. So, but I think from a perspective here, the Saudis just don't have the spare capacity that they used to drastically increase production. And if they do increase production slightly, right, it's mostly heavy sour crude, and I'm not even sure the U.S. refiners can all refine that anymore at this point.
Yeah, and that's the thing. Now they're not increasing production; they're just not cutting production. So it's not. They haven't announced that they went, we're going to increase production to drive out those shale players. No, I don't think they're really all that worried about the shale in the long run, because they know it's going to peak anyway. I mean, you look at any of these studies, the shale oil production is going to peak in a few years anyway, just because you get to a point where there's so many declining wells, you can't drill enough new wells to replace those, because these shale wells, the production does decline pretty rapidly, like 50 to 70% on a well-by-well basis decline in the first year. So still, the economics are still outstanding in the good parts of the plays.
Okay, so let's transition next to shale, because that's your specialty. You cover the United States shale oil industry extensively. You have a background working in there, I think, with Hess Oil, right, prior to starting your own Energy Prospectus Group. I want to talk about Harold Hamm's comments. He came out the last couple of weeks. He said he doesn't think the oil price could go that much lower. He took off all his hedges for oil production with board of director approval. What's your opinion there on Harold Hamm's assessment of the oil market? Obviously, the oil market's gone a little bit lower than he thought, but do you think there's that much room for it to go lower going forward in the near term?
Well, unless oil prices stay down for a year, he probably did the right thing because he got $433 million by cashing in those hedges. He didn't just take them off. He took them off with a big check. It's just like any futures put or call option you sell, you can cash them out at some point, and that's what he did. So he got a big cash payment for doing that. So it remains to be seen if that was a wise move. It was just a strategic move. And I've seen other companies do it before. That's not the first time. If they think the dip is just temporary, then they cash out of the hedges and just say, okay, we'll take our chances and re-hedge when the price goes back up again. So anyway, I just don't think this can last all that long. Here, with lower oil prices, with lower fuel costs, they reported yesterday that gasoline's below $2 in Oklahoma now. With lower fuel costs, you're going to see increasing demand. There'll be more people that'll, can afford a big truck or an SUV or whatever, and they'll do it, and you'll see some increasing demand. So I think this stuff will take care of itself, and you will see. There's no doubt about it. When this happens, there's always some marginal supply that gets shut in pretty quickly. So there'll be several 100,000 barrels a day taken off the market from strip of wells or water floods or tertiary projects that just can't handle this price, and they'll get shut in. So there'll be some reduction, some offshore stuff especially. And you'll see offshore projects canceled, and you'll see drilling in the shale plays maybe cut back 20 or 30%. So in a relatively short period of time, relatively like a year to 18 months, there'll be a pretty significant slowdown in production growth in the U.S. So.
Yeah, the Chinese have started to stockpile oil, I think, on tankers, and they're starting to put a bottom for demand into the price. They know that these cheap oil prices, just like you said, they're not really sustainable. Yeah, they did this after 2009 too. They locked in long-term supply contracts with both Russia and Brazil, and I remember them being heavily criticized by the people on Bloomberg and CNBC that, you guys are paying $10 or $15 over the spot price for these long-term contracts. You're so foolish, China. You're wasting all this money. You don't know what you're talking about. And then, the oil price went way above what China locked in the oil price at. So I think China is long-term thinkers and they're shrewd. This goes back to production costs, though, and what you said here. Before the oil price dropped so much, there was according to the BP statistical review, global demand was rising faster than global supply, and really the only production increases in the entire globe, I think almost 85% of them were all shale oil. Yeah, with
if you look by continent, North America is the only continent with significant increase. It's all coming from primarily the shale plays, but also the Canadian oil sands projects. Those are the only places where you get a significant increase. Then, of course, offshore too. Gulf of Mexico is still an increasing area. So outside of that, everything else is flat.
Yeah, I agree. And they're spent the amount of capex at all these global oil companies, whether it's ExxonMobil or BP or Shell Oil, who just canceled I think a $8 billion project in the Arctic because they couldn't make any money on it. And the national oil companies, they're spending so much on capex, and the global supply, like you mentioned, it couldn't increase. So it's just an amazing story. I read the Frackers book. I don't know if you read that book, but just amazing what Harold Hamm at Continental Resources and what so many of these other guys were able to do with horizontal drilling and stuff.
That's incredible.
Now, what's your opinion on the production costs of the industry? I'm reading pretty much everyone now since the oil prices dropped. We're seeing an increased coverage on oil throughout the mainstream media. We're seeing everyone come out with articles on production costs. Most of them are averages. What's your opinion for the production costs then in the Bakken and the and also the Eagle Ford? Do you think that the companies have been able to lower production costs meaningfully and keep production at normal levels, or do you think that?
I looked at we have a portfolio called the Sweet 16, and there are kind of our mid to large cap companies that we follow. And I looked at the 8 largest. I call it the Elite 8, and their actual production, all in cash production cost. Now don't confuse finding and development costs with production cost. I'm just talking about lease operating expenses, production taxes, gathering, processing, transportation, marketing. What it costs on existing wells to get oil and gas out of the ground and market it. that is running anywhere from Range Resources is only about $7.50 a BOE, up to maybe like $12, $14 for some of them. So that's the range. But I would say the average for the largest 8 companies in our model portfolio is $11 to $12 a barrel. And fuel costs make up a lot of production cost. So as fuel costs come down, those costs will come down. And of course, production taxes automatically come down because they're just a percentage of the sales price. So we're probably going to get production costs, and then in the first quarter next year will be below $10 a barrel.
Now, those cash costs, production costs, those don't include interest expense and the normal expenses of running any business like selling, general, and administrative. How much more do you think those other costs add? Did they double the cost or triple the cost?
Well, interest expense is, that's on a company by company basis, so you don't look. But just G&A costs, back office costs. You're only talking about $2 or $3 a barrel or something.
Okay, so you think then that the market has drastically overreacted then to the majority of shale players because we've seen.
What you're seeing when you see these guys saying what the break-even costs are in the shale plays, that's all in capital cost. That's what it costs to drill new wells, not just to continue producing existing wells. So that's what it costs to go out and drill a $10 million well to drill and complete that well. And a lot of them also include the leasehold cost. And I made a presentation today. I said, when you're deciding on your capital budget for the year, you ignore sunk cost. Those leasehold costs, like Continental, they recovered their leasehold cost two times already. So those are sunk costs. So when they decide to go out and spend capital for next year, they're saying, okay, how much am I going to have to write checks for on these new wells, drilling and completion costs, and then what are my netbacks going to be and how long is it going to take to pay that back? And another thing to remember is fuel costs are a huge part of the drilling cost. Maybe 10 to 15% of your drilling cost is actually the fuel cost. Because those big rigs, they don't get 20 miles to a gallon. They're sucking down that diesel as fast as you can pump it in there. So that's a big deal. We were talking to this guy, he had Hemisphere Energy, which is a little Canadian company, but he said that they're already seeing their drilling cost forecast come down about 10 or 15%. And the rig companies always work with the E&P companies because they don't want to stack rigs. So they'll lower their day rates. And, I could see what used to be a $10 million well getting down to about $8.5 million. And another thing is we go into the sweet spots of the shale plays that they've already drilled what they need to drill the whole acreage. So they're going to concentrate on the sweet spots. This is what you'll see: Continental, EOG, Cimarex, Concho. They'll focus on their area, their proven areas where they know what they're going to get, and they're moving to pad drilling. So you get this rig on location, so you eliminate your rig move cost, and you're going to drill 8 to 16 wells per pad. And that significantly reduces your drilling cost too. So you can't look at this all in a vacuum. When oil prices come down, all oil field services costs also come down because so much of it is fuel costs.
Yeah, that's very interesting. Now, do you think then that the oil services and drilling companies, they're obviously having pain, but their order books are still pretty strong,
right?
Especially Halliburton and these guys. Do you think companies like that are pretty good investments still in long term?
Yeah, well, when there's capital cutbacks, the first ones that get hurt are the drilling companies because, if everybody cuts back on their drilling programs, you immediately cut back on rigs. Now there's got a lot of, high dollar rigs in their long-term contracts, and, unless they want to get into a legal battle, they're tied into those long-term contracts for a while. But the marginal, day rate, the rigs that were just on a well-by-well basis, those will be the ones canceled first. So they're the ones that kind of get hurt. But the big oil field service companies like the Halliburton, Schlumbergers, all that, remember, their business is tied to completing wells, not to drilling wells that much. So the big frac crews. So until they use up the inventory of wells that have already been drilled to be completed, and that may take 6 or 8 months. So you're not going to see a big drop off in fracking crews and everything unless this goes on for quite a period of time.
Now, you cover a lot of companies. You cover at least 16 for your Sweet 16. You also cover a portfolio of emerging mid-tier and junior oil producers, mostly in the shale area, but also a few in emerging markets. Which of them are generating free cash flow at these levels still, and you think are pretty good investments for the more conservative investor?
Well, I stick with the biggies because they'll not only survive, they'll thrive. They'll gain market share and be able to pick up on some stuff. And I tell you, the group that I really like is the upstream MLPs. I looked at Lynn Energy yesterday, and I'm going to be looking at Brightburn here, Vanguard, Natural Resources. Another one is Memorial Production Partners, which is MEMP. And these guys have got so much of their production hedged. I mean, really high percentage of their production, 70, 80, 90% of their production is hedged at very high prices. I looked at Lynn yesterday. They got 60% of next year's production sold at $94 a barrel, their oil, and they've got 90% of their gas sold at over $5 an MCF. So they're in really good shape. In fact, they're going to report huge fourth quarter gain on their hedges. But these guys are in good shape. They've got some really, sweet spot acreage, and they're going to still be very profitable. Now, when you say free cash flow, that's another confusing term that a lot of people use. Are you generating more cash flow than your capital program? And I think a lot of these guys, especially guys that have quite a bit of debt, they'll be forced to stay within operating cash flow. So they're going to have to cut back their capital programs to what their operating cash flow is.
Okay, and great insights on Lynn Energy. Do you offhand know how far they're hedged out, just in case this lasts longer than 6 to 8 months?
Well, they have hedges in place for the next 5 years, but it's declining percentages.
Okay. Well,
but they have a table. It's for your listeners, on all these guys on the upstream MLPs especially. If you go to their websites and click on the investor tab, every one of them has a pretty detailed hedging schedule there that's pretty easy to understand.
Well, you and me are still bullish long term on oil, and I was kind of surprised by this much of a drop in this short amount of time. But
yeah.
I'm still extremely bullish long term on oil. I think the rest of the world, especially the developing world, demand still increasing for a number of reasons.
Yeah, and I think this could be a very bullish situation for natural gas too, especially if we have a cold winter, because we've been filling our gas supply with associated gas. We're not drilling many gas wells like in the Haynesville or the Barnett. It's the associated gas with these Eagle Ford wells and Permian Basin wells. So if that drops off by 20 or 30%, you're going to have a lot less associated gas. And then at the end of 2015, we've got LNG exports kicking in. So I think the outlook for natural gas prices 12 months from now could be significantly better.
Well, yeah, especially if those LNG export facilities, those things still go through. Because look what Russia is doing to their exports for natural gas to Europe. I mean, Russia just basically signed most of their exports that were supposed to go to Europe. They're going to China now on long-term deals. So, I wonder.
Cheniere's going to be. I mean, the facilities are already approved and going forward. I mean, just Cheniere is going to ramp up 4 trains here. That's going to increase demand by 8 BCF a day within 2 years. So, and their first train goes online the end of next year. So.
Yeah. Cheniere was a speculative stock I talked about when it was $6 after 2009. I thought it was. Yeah, that was one of my winners, one of my huge winners the last time. But they have most of their stuff on long-term contracts, so that's a good sign. What's your opinion then, Dan, on some of the larger shale oil producers like an EOG, a Continental, and a Whiting? Are these guys also hedged? Continental's not.
Continental's not, but some of these other guys are pretty well hedged. Plus, remember, I mean, they own some really sweet spot acreage, so they're going to be profitable. And they don't just produce oil. I mean, they produce a lot of natural gas and a lot of NGLs. So now is a really good time. And I tell our members all the time, take a real hard look at the production mix. Take somebody like Cimarex. I think Cimarex is a screaming buy at this price. XEC is that symbol. They produce a whole lot of natural gas, a whole lot of NGLs. They're very low-cost producer. they got a great marketing group, and they're going to be profitable no matter what. I mean, I assumed $70 oil forever, and I still come up with a pretty high, breakup value for that company. EOG, of course, EOG's probably got the best marketing group for oil in the whole world, and so they get several bucks a barrel more than the competition. Range Resources on the gas side, about 70% of Range Resources production from Marcellus, and they also have an outstanding marketing department. And so they're connected to 15 or 20 different pipelines, so they can always get their gas to the highest market, and they're going to be profitable. And in fact, they have one of the lowest production costs. Their production costs are under $8 a BOE, so they're in really good shape.
And very good. And what about Whiting with their recent acquisition of Kodak Oil and Gas? Is that going to force their production costs up, or do you think they're going to be able to survive this?
Well, from a stock price situation, whenever you have a big merger like this, it always takes a couple of quarters before everything kind of settles down. I still think they look good, but I think the market's going to be very nervous about that deal. So right now, I would just have it as a hold. I think when all's said and done, they're going to be in really good shape.
Very good. And my last question here about oil production here, or buyouts actually in the shale oil. Now that the prices have gone low, do you think if maybe we see another 6 months or 8 months or even a little longer than that, do you think the ExxonMobils, the Chevrons, the Shells, the BPs, do you think they're going to come in and try to buy out, try to get some of these mid-tier producers or larger guys to sell out?
I tell you what, if I was on their board, I'd be telling them to take a darn good look at it. I mean, you can go out and buy reserves now on Wall Street a heck of a lot cheaper than their finding and development costs are. I mean, I don't know why they're not doing it. I would be scooping these things up. They resisted it, but boy, they got the cash. They got the strong balance sheet, so they could sure do it.
Or they could do an all-stock deal, right? I mean, if the stock's low now, just add production and reserves. Yes, in the short term, your stock price is going to take a hit. You're not going to get your options package next quarter, but
so what? Go out and buy them. Go out and buy them with cash, man. Just sell what you don't want. I mean, the one thing I noticed with Lynn Energy, I was working on that. They did this big merger with Berry Petroleum, and they're selling off the assets they don't want, and then they're going to end up at the end of the day and heading into next year in pretty good shape when all these deals close. And that's what you can do. That's what an Exxon could do. Go buy a Concho or somebody, and then just sell off some of the properties you don't want to keep the really core stuff, and you're going to end up with some really good reserves.
Yeah, Lynn Energy's built. I covered Lynn. I told you, I covered MLPs last year when I worked at Investing Daily. But I studied the history of Lynn Energy. I mean, they've built their whole company through acquisitions. So I mean, they're used to buying assets and chopping up and getting rid of the stuff they don't want and keeping the good stuff. So I think they're good at what they do. I mean, not everyone's good at acquisitions. Obviously, companies screw up acquisitions all the time, but Lynn Energy's really good at it. Yeah.
That was pretty good. And, Lynn Energy, LINE, is an MLP, but you can also buy Linco, LNCO, and it's just a C Corp, and their only asset is their interest in line. So you're basically buying the same thing, but you get a little bit higher dividend rate, but it's taxable, where in LINE, most of those distributions are tax deferred.
Yeah, very, very good. Yeah, because there's problems there if people buy an MLP and then they sell it without holding it for a very long time.
Right. Yeah.
But if you buy and hold the MLP for forever for cash flow, or you die and you pass it on to your heirs, they don't pay any taxes on it. I believe the way it's structured right now.
Right. Yeah.
Now, my final question, Dan, is about the pipeline companies for the shale oil. If the oil prices do go much lower, and let's say there are some production cuts for some of these shale oil companies, how's that going to affect some of the pipeline MLPs you cover, like Plains All America or Kinder Morgan or Enterprise Products Partners, who have deals, to put the pipelines from either the Eagle Ford or the Bakken?
Well, first of all, production is going to continue to increase at least through next year. So I think they're in pretty good shape. And remember, unless the U.S. economy goes down, and these lower fuel prices are going to help our economy, it's going to be a major stimulus to the economy. And as the global economy grows, so does demand for energy. So just think they're kind of the middleman between the producers and the consumers. Well, as long as consumption is going up of fuels, then they're in good shape. And they all look in good shape. I think that's an area to really look at. I got a report from Raymond James just yesterday, and they thought that was one area that's been grossly oversold compared to the fundamentals of what their business are, and their revenues are tied in by long-term supply contracts. So.
Yeah, I think the pipelines are they have long-term contracts to move the oil or the natural gas or the NGL through the pipe. I think those are some of the best conservative investments people can make right now, especially people who are out there looking for yield. In my opinion, Dan, I don't know if you agree with this, but I think this is probably the best time since 2009 for people who haven't invested in any oil-related investments yet to start looking around. And yes, there is,
especially if you're looking for high yield. I mean, these MLPs are now paying like 15, 16, 17% yield. There's some preferred stocks. Look at some of the preferreds that are now below par and, 9, 10, 11% yields on them, and they're pretty darn safe. So now's a good time to lock in some nice high yield if you're looking for that.
Yeah, and it beats a lot of bond investing, especially investing in government bonds and things like that. Although if people are going to go out and buy junk bonds or things like that from some of the shale oil companies, I'd be very careful with that. But I think the MLPs are structured where they tend to be safer than buying some of the high yield debt.
Yeah, I would I just look on the E&P side or on the MLP upstream MLPs. Look at production mix. What are they really producing? Break it down between natural gas liquids, and crude oil. Because the only thing that's really come down is crude oil prices. The other stuff is held pretty firm. And then also look at their hedges. How far out are they hedges? So how much of their revenues protected? And then go from there. And then of course look at their debt, and then look at their debt structure. Like what's their current line of credit, and then how much debt do they have coming due in the short term? If that's going to be a problem. So.
Yeah, I completely agree. Yeah, people have to look at debt in this environment if the company's hedged, because if the oil prices stay lower for longer than you and I think, some of these companies that are over leveraged and don't have hedges in place, they could be in trouble. The bankers, the people on the board of directors there could go in there and force them to start selling assets or things like that at bad valuations.
Yeah. It's got to go on for a while though. I mean, this stuff doesn't happen overnight, and these cycles have been a lot worse than this, and oil prices have dipped a lot lower than this. So it's got to go on for a year before there's any serious pain that causes that. So we'll see. We're going to learn a lot more when these year-end reserves come out. So reserves come out at the end of the year. So.
Yeah, so some people in Texas, Dan, not you as my source, but I have other sources in Texas, and from what I've heard, there's some oilmen down in Texas who think that the Saudis, just by keeping production at the same levels, and the shale oil producers still producing, like you said, the oil price can stay at between 60 and 85 a barrel for at least a year, but I don't know about that. We'll see.
We'll see. Well, it's going to increase demand. When these fuel prices come down, it increases demand. You'll see it. Because it's going to stimulate the economy, the global economy, like crazy. I mean, consumers, think about it, every car out there is now, a 2-car family, they may be getting $150, $200, a month or something in fuel savings. So maybe not that much, but even $100, but they're spending it on something. Then they'll go out and spend that on something else, and it does stimulate the economy.
Well, I just want to thank you again for your time, Dan. And if our listeners want more in-depth coverage of MLP yield investments, or some of these producers in the shale plays that have better financials and can survive these low prices and will recover when the oil price goes higher, how can they do so?
Well, if they want to just send me an email to energyperspectives@gmail.com, then I'll send them a copy of our last newsletter, and they can kind of see what we do.
Okay, great. Yeah, and I get Dan's newsletter and I read it. I think it's very interesting stuff, and you do a good job covering all the United States companies, which I think most investors here in the United States are most comfortable with. As you and I were speaking, Dan, I think most United States energy investors don't like investing abroad, although if you're willing to go abroad, there are better valuations. But the ones I speak to in Texas who invest, they say that, they're the oil companies are just so well managed here, most of them, that why should I go to another country?
Yeah, right. Yeah. then you have country risk and currency risk and all that. So anyway,
Yep,
Jason, thanks a lot.